All right, today we are digging into Radian Group's second quarter 2025 earnings call. And let me tell you, this report sent some seriously mixed signals to the market.
Okay, so let's get right to the heart of it. The big question this quarter. Radian comes out, they beat earnings expectations, which, should be great news. But instead, the stock takes a 2.6% hit that day. So, what gives? What did Wall Street see that made them overlook that headline win? That's exactly what we're going to unpack. To really get to the bottom of the market's reaction, we have to start with the numbers. And this quarter, it was truly a tale of two very different metrics. And here's the scorecard. You can see it right here. A split decision from Wall Street. On one side, you've got a really solid beat on adjusted earnings per share, $1.01, which was well above what analysts were looking for. But on the other side, revenue came in at $318 million, a slight miss. And more importantly, it was basically flat compared to last year. So you've got this weird combo of profits going up, but the top line, it's just not growing. That's our first clue.
But here's where it gets interesting. If you look past those big headline numbers and you go down into the engine room of the company, I'm talking about their core mortgage insurance business, the picture starts to look a whole lot stronger.
And this number just proves it. $277 billion. That's their primary insurance in force. Basically, it's the total value of all the mortgages they're insuring right now. And it just hit an all-time high. This is the stuff that drives future earnings, and it is looking really, really healthy. And get this, management is not just sitting on those profits. They are sending cash back to shareholders, and they're doing it aggressively. In just the first half of 2025, they've returned over $500 million through dividends and stock buybacks. And just to put that into perspective for you, the amount they spent on buybacks in just 6 months is already more than what they spent in all of 2023 and 2024 combined. That is huge. So, how healthy is that giant portfolio? Well, it looks fantastic. You see, cures, that's when a defaulted loan gets paid up and becomes current again, they continued to outpace new defaults. And in fact, the number of new defaults actually dropped by 8% from the last quarter. This is the exact trend you want to see if you're a mortgage insurer. It's a sign of a very strong book of business. So you've got a record portfolio, amazing credit health, and they're returning a boatload of cash to shareholders. You can imagine management had a pretty confident story to tell analysts on the earnings call. So let's take a look at their bull case. CEO Rick Thornberry basically laid it all out with this one quote. He framed the whole quarter around two key pillars. One, the strength of their core business, and two, their disciplined, shareholder-friendly way of managing their capital. This was the narrative they were really hammering home on the call. So if we break that down, they were hitting on 4 main themes. First, that great credit quality we just talked about. Second, something they called persistency, which is just how long people keep their insurance policies. It's at a strong 84%. And why is that so important? Well, because over 60% of their loans have mortgage rates under 6%. In today's environment, that business is locked in and isn't going anywhere. Third, they kept saying their buybacks were immediately accretive to book value, which is just a fancy way of saying they're creating direct value for shareholders. And finally, they pointed to their rock-solid financial position, which is all thanks to something called the PMIERs cushion. Now, what on earth is that? Well, think of it like this. It's the extra pile of cash they have to keep on hand above the bare minimum the government requires. And Radian is sitting on a massive $2 billion cushion. That signals incredible financial stability. Basically, they have the firepower to handle pretty much any economic storm that comes their way. Okay, so if the core business is a fortress and management is returning cash hand over fist, we're back to that original question. Why the heck did the stock drop? Well, the answer is that the market was looking at everything outside of that core fortress. And this slide right here tells the whole story. It's the perfect picture of the disconnect. On the left, you have management's message. They were laser-focused on the core portfolio, the great credit quality, the buybacks, all of which led to a really impressive 12% jump in book value per share. But the market? Its eyes were glued to the column on the right. That flat revenue, the really sluggish 3% growth in new insurance written, which is the new business they brought in, and this noticeable drag from their other non-core business segments. And that drag had a very specific and kind of ugly number attached to it, a $16.4 million loss from their all-other segment. Now, this wasn't just a rounding error. It was way worse than the $3.5 million loss they had last quarter, and that's the kind of thing that definitely gets investors' attention.
So where did that loss come from? It was basically two things. First, they took a $9 million hit in their mortgage conduit business, which they blamed on market volatility. And second, they made a strategic call to just stop investing in a real estate tech venture. For the market, this just created a lot of noise and uncertainty outside of what should be a clean, predictable business. Okay, so we've seen the strength in the core, the weakness on the fringes, and the market's pretty skeptical reaction. Now it's time for our forward-looking take, the next call.
So, we're going to structure our analysis around three key things for you: what we're watching for in the next quarter and beyond, what we think the stock price is going to do, and of course, our final official reading. Looking ahead, we've got our eyes on four key catalysts. First, can they get that new insurance written number to pick up steam? That's your best indicator of future growth. Second, will they keep up these aggressive buybacks and continue to pump up that book value per share? Third, we're watching credit trends like a hawk. Any weakness in the job market could show up there first. And finally, can they stay disciplined on costs and hit their target of an 8% reduction for the full year?
So it all comes down to this core conflict, this tug of war for any Radian investor right now. On one side of the rope, you have this incredibly profitable, durable core business that is just gushing cash back to shareholders. But on the other side, you have these very real concerns about future growth and the messy drag from these other businesses. Because of this tension, we really expect the stock price to be pretty range-bound for a while, just kind of stuck until a clear catalyst shows up to pull it one way or the other.
And that brings us to our final rating for Radian Group, which is market perform. Look, the massive capital returns and the stability of that core business, they provide a really solid floor under the stock. It's hard to see a lot of downside. However, that lack of top-line growth and the headaches from the all-other segment are probably going to act as a ceiling, capping any significant upside, at least for now.
This is not financial advice.